Hello, everyone. I'm your host, Saijal Patel, and this is Strictly Money at the News Forum. With Canadians clamoring to get into the hot housing market, it shouldn't be surprising that record mortgage volumes have pushed consumer debt to more than $2 trillion. But there's another concerning trend, and that is the growing dependence of Helocs, home equity lines of credit. Joining me now to discuss the most recent consumer credit trends is Rebecca Oakes, Assistant Vice President of the Analytics team at Equifax Canada. Rebecca, thanks for joining us today.
Thank you for having me.
So I read your report, lots of great data there. From the trends that you are seeing, if there is one key message that you would give Canadians who are looking out for their financial well-being, what would you say to them?
Well, it's a really uncertain period that we're going through due to the pandemic. So my one piece of advice would be really careful or really aware in terms of your own financial situation right now, and look to the future in terms of what could happen and what could be coming around the corner, and just thinking about, can you really afford to kind of make your payments if things do start to change for you? Because individual circumstances are always different.
What is the latest growth trend behind Helocs? Are they using it towards retirement or funding a lifestyle? What is it?
So it is difficult for us to really identify exactly how they are used, because unfortunately we don't see that information. We know things like renovations have been up in 2020 and in 2021. Being at home is so much more important just due to the pandemic, really, and people aren't going out and doing things they used to do. So we definitely expect some of that is really linked to kind of investment in the home, whether it's outside or inside.
Okay. So for those who may not understand what Heloc is, can you explain how it works and what homeowners need to be aware of?
Absolutely. So there are different variations you can get, but normally how it works is you have your mortgage, and linked to your property value, there will be an equity level to that, depending on how much your mortgage is in relation to the home price, kind of what your property is worth. And what you can do is you can have a line of credit that is linked to that equity within your property. So you can kind of draw down against it. You have a limit, a bit similar to a credit card, but it tends to be much higher. And then, you can kind of use that equity almost in there as an ongoing basis as a credit mechanism. So they do tend to be higher balances, higher limits, tens of thousands of dollars, just because they are linked to that equity element in your home.
Okay, so is the concern then that they're, I think, linked to variable rates and that we could see rates go up? Is that the big concern?
Yeah, absolutely. I mean, it's been a really long period now of low interest rates. And again, that's partly due to the impact of the pandemic. And what you can find is that, when those interest rates could go back up again, and they will do at some point, those payment amounts can increase by quite a lot, because again, they're very high balance and typically variable rate. And that is kind of the area of concern, is just, are consumers thinking about that, and kind of when that might happen and what the impact might be to them.
Rebecca, what happens if they miss a payment then? Or say the home value goes down?
So if the home value goes down significantly, I mean, that's quite unlikely in terms of some of the forecasts. Yeah. You can end up with quite a challenging situation where you have things like negative equity, but we don't really foresee that coming. If you miss a payment, it's a bit like any other type of credit. If you miss a payment, obviously there'll be kind of maybe fees associated with that. There obviously will be additional interest. But on your credit file, we will see that as a missed payment, and that can start to impact things like your credit score and your ability to get future credit.
What's going on with other types of debt, like credit cards, line of credit? What sort of trends are you seeing there?
So if we go back to pre-pandemic levels, we obviously saw credit card balances were very high, unsecured lines of credit were very high. During 2020, those really reduced. We saw reduced spending, again, because consumers potentially weren't going out and kind of spend on the same things they used to, like vacations and things like that. But we also saw much higher payment rates. So there were some consumers that potentially ended up in quite a good situation as a result of the pandemic. They weren't having to commute. They maybe were kind of receiving government support and things like that. And we saw a lot of consumers leveraging that opportunity to pay down some of their debt. So we have seen real lows in terms of credit cards. What we are starting to see in Q2 was that that's starting to shift a little bit. So we're seeing spend pick back up again. We're seeing payments reduce a little bit, and we're seeing balances start to creep back up again. So it's still relatively slow, but it's definitely kind of starting on the upward direction as opposed to this downward trend that we've been seeing.
Okay. We're going to have to leave it there, but great insight. We'd love to have you back.
Thank you so much.
That was Rebecca Oakes of Equifax Canada. We're going to take a quick break, but when we do come back, we're going to continue this conversation on using equity in homes when it does and doesn't make sense. Stay with us. Welcome back to Strictly Money. We've been talking about HELOCs and the growing trend in relying on them to supplement housing affordability. To continue the conversation, Jason Heath of Objective Financial Partners joins us with his insights. Hi, Jason.
Hey, Saijal. Thanks for having me.
So we were talking to the previous guest about this growing dependence on debt, and not just mortgages, line of credits, credit cards, HELOCs, because people so badly want to get into the housing market. How much stress is it putting on the household budget? Can you give us some context?
Well, I mean, it depends how you come at it. When you look at the 80s and the 90s, mortgage rates were over 20% in the early 80s, and they stayed over 10% well into the 1990s. They've declined since. And when you look at housing affordability, at least on a national scale, the last 25 years, as interest rates have gone down, housing affordability, the amount of our after-tax income that's being spent on housing has stayed pretty steady for the past 25 years. It's artificial because interest rates have come down. But on a national level, at least the housing affordability numbers look pretty similar now to what they were previously.
You know, it was interesting, Jason, because there was an article recently that says that nagging people about debts with threats of higher interest rates is lame because it doesn't work. As long as people have economic stability, they're going to continue to borrow. What do you think about that?
I think debt has become more fashionable and acceptable. Interest rates are so low. It's very tempting to borrowers. And I think even more importantly, if you're a young person in particular and you want to own real estate, you're forced to take on a big debt if you live in an expensive city like Toronto or Vancouver. So I think in part borrowing has become more acceptable, but frankly more necessary depending who you are and where you live.
Jason, what percentage of mortgages or housing costs should make up the total budget? What's a good rule of thumb?
Yeah, it's a good question. When you look at the past 10 years, the Housing Affordability Index has been relatively steady between 30 and 35%. So what that means is the average household's after-tax income, 30 to 35%, I think it's creeped up to about 36% currently, is being spent on mortgage payments and utilities. I would love to come up with a nice, easy rule of thumb to say you shouldn't spend more than 28% of your income on housing or something like that, but I find it's not that simple. It really depends on your own personal circumstances, your age, your other savings, your future income prospects. If you're a young person, are you going to have 3 kids or, are you not going to have children? There's so many factors that make it hard to come up with a one-size-fits-all answer.
Yeah, it is very personal, isn't it?
Yeah.
What about this myth, because you hear it a lot, that renting is a waste and the only way to go is actually buying a home? I have this conversation with people all the time that when you actually look at closing costs and renovations and maintenance and taxes, that might not necessarily be true. What do you say?
I do think it's somewhat of a myth. And I think the challenge in Canada, at least, is there's a lot of homeowners who were in the right place at the right time over the past 25 years, who made a lot of money from real estate. And they're often the ones giving that advice. I think the experience in Canada is very different than what we've seen in other countries. And the experience in Toronto, for example, is very different from the experience in Calgary, Alberta. Home ownership has ancillary costs like property taxes, repairs, maintenance, things that I don't think people take into account when they look at how much their home is appreciated. And frankly, over the long run, stock markets have provided better returns than home ownership. I think a big consideration, as you alluded to, is the cost of buying and selling as well. Land transfer tax real estate commissions, they add up when you're buying and selling. So typically my advice is that if you're not going to live somewhere for at least 5 years, I think that's a case for renting instead of buying. But I think the most important consideration for me is whether or not you can afford to buy. If you'd have to put every penny you have into a down payment, or if you'd be in a really tight budget on a monthly basis, where you don't have an emergency fund, you don't have extra cash for living a little bit, I think I'd think twice about buying. And real estate prices, they can't rise at the same rate over the next 25 years as what we've seen over the past 25 years. You can't have real estate prices rising like this and salaries rising like this. It's not sustainable.
All right, we're going to take a quick commercial break. We'll be back in 2. Jason, when it comes to talking about homes and using that as a retirement strategy, I think the first point I would say, and from everything I've read, is that Canadians aren't even saving enough for retirement. There's so many people, in fact, a big percentage of people that are nearing retirement and in fact have nothing saved. And to me, the concern is that they're banking on their home for the funds.
I would agree. I think there's a lot of people there's a lot of people who are taking on big mortgages that frankly, they're not going to pay off prior to retirement. And I think it's even influencing seniors to a certain extent who are hesitant to sell their home. They're hesitant to downsize because their home is going up by so much. What are they going to do? Sell it and invest the money? Where are they going to earn a better return? Whether that is the right approach or not, I think there are people who, many Canadians who've just placed so much focus on real estate as being the best investment strategy.
Do you think there's an over-dependence on Helocs and that could grow?
I think so. When you see the Heloc numbers about the average balance on a Heloc or the increase in Heloc debt, the thing with a home equity line of credit that scares me is typically if somebody has a mortgage and a home equity line of credit, when their mortgage comes up for renewal, which typically at most is every 5 years, people will often roll their Heloc into their mortgage. So when you see these Heloc numbers that are staggering, it makes you think, geez, if people are spending more than they're making consistently, that's not a very good trajectory. I think there's a lot of people who are relying on Helocs to maintain a certain standard of living. And I suppose if real estate continues to go up the way it has been, and interest rates stay low as they have been, people aren't as concerned about doing it. But both of those things could change, whether it's real estate prices not rising at such a staggering pace, or eventually interest rates are going to rise.
When does Helocs make sense? And the second part of that question is, how should one actually use it?
Well, I mean, I think a Heloc can be a great emergency fund. I encourage people to get a home equity line of credit as a backup plan. It might mean that you don't need to keep as much money in sort of a traditional emergency fund. But there are those people who are tempted, I suppose, to use a home equity line of credit, which isn't necessarily a good thing. A home equity line of credit, if you're using it consistently, it's a sure sign that you're spending more money than you're bringing in. And I think it's a reason to be looking at your budgeting and looking at your overall financial planning to make sure that you're staying on track.
Jason, what about reverse mortgages? Because they work slightly different than Helocs, don't they?
Yeah, they do. So a home equity line of credit, which a lot of homeowners are familiar with, is a line of credit that is based on the equity in your home. It's a credit facility that you can borrow from at any time, and you only pay interest on the money as you take it out. The interest rate tends to be at prime plus 0.5%, sometimes prime plus 1%, so sort of in the 2.95 to 3.45% range. One of the challenges with a HELOC for somebody who's retired is banks are hesitant to lend money to people who don't have an income, as many retirees don't, or they have modest income. So a homeowner in retirement may not be able to borrow as much. A reverse mortgage is a way that money can be borrowed, typically up to 55% of a homeowner's equity if they're over the age of 55 can be accessed using a reverse mortgage. There's only a couple of providers in Canada right now. And a reverse mortgage is a mortgage that you can take money out on a lump sum, or you can be paid monthly amounts that increase the debt that is secured by your home equity. And you don't have to pay it off until you sell or until you die, at which point it becomes fully payable.
Well, we only have about 30 seconds before a commercial break, but a quick question. Is there a better retirement income strategy?
I mean, look, in a perfect world, people save up enough along the way and have sufficient pension and investment assets to be able to fund their retirement. But this is the real world. There are going to be people who go into retirement with debt and who need to consider using home equity. Using a home equity line of credit or a reverse mortgage, I think, are both options instead of selling or downsizing a home. And for some seniors who want to stay in their home, I think it can be suitable.
Okay. We're going to take a quick commercial break. And when we come back, Jason, I want to continue that conversation and ask you about downsizing options.
Sure thing.
Welcome back. Our guest has been Jason Heath, a fee-only financial planner and also a regular contributor to Money Sense. So Jason, I always love reading your articles on Money Sense.
Thank you.
Downsizing in retirement. A lot of people do it, and presumably one of the reasons is to free up capital. It doesn't feel like a realistic option, though, for a lot of people.
I mean, it can be. I think one of the challenges that I see in practice is that there's not as many seniors who are downsizing. I see it within my own practice with the clients I'm working with. But there's an article I wrote recently, actually, for the Financial Post, and it was about the retirement downsizing myth and a couple interesting stats I came across. The Ryerson's National Institute on Aging found that 9 out of 10 seniors said they would like to try to live independently in their home as long as possible. And looking at a big data pool from Statistics Canada, the 2016 census found that seniors are actually less likely to move than the general population, with only about 5% moving in the previous year compared to 13% of the general population. So seniors, frankly, aren't downsizing the way they were expected to. Mm-hmm. And I think that's something for young people to consider as they bank on potentially downsizing in retirement.
So what's the rationale behind it? Is it they can't find something suitable, they'd have to move far away, or health reasons, social reasons?
Yeah, I mean, I think there's a number of different factors. One that I commonly see is for somebody to sell their home and move into a condo, there's transaction costs to do so. The condo cost per square foot can be relatively high. And there's a lot of people I find who realize they can't really come out of it with much money. So as a result, they decide to stay in their home. There's other instances where people would need to move to a lower cost city or town in order to have a true downsize. And oftentimes people say, well, you know, I've got my friends, I've got my doctor, my dentist, my social circle, it's where we live. So, you know, we couldn't imagine moving anywhere else. So in practice, what I'm seeing, even though in theory this downsizing opportunity could work well for seniors, in practice, I'm not seeing it happen.
So what are some of the considerations people do need to look at in deciding whether to do it or not?
Well, I think the starting point, I hate to put money ahead of lifestyle. I think I would start with lifestyle considerations. You know, if somebody wants to downsize or wants to move somewhere else because it's a better quality of living, you're on one level instead of a two-story home, for example, that's one thing. Financial considerations often play a factor, and there's going to be people that have no choice but to access their home equity in some way, shape, or form. We've talked about home equity lines of credit, reverse mortgages. Those are options. Some people don't like that. Some people would choose to sell their home or downsize, or frankly, just sell and move into a retirement community where they're renting. So they have money and they feel more comfortable during their golden years.
Based on the work that you do and the mistakes that you probably see, if there is one message, Jason, that you would give to those getting close to retirement, what would you say?
I think one message is that going into retirement with debt isn't necessarily a bad thing. Obviously, people would prefer not to do so. There's going to be situations where there's no choice. But the most important thing I think any pre-retiree can do, whether on their own or with a professional, is come up with a retirement plan. Where is your income going to come from? What are your expenses going to be? What pensions, government or private, are you entitled to? And try to determine how your retirement looks. It's tough to do on the back of a napkin, but there are professional retirement planners out there who can help with that sort of an approach. And even if the picture is not a pretty one, knowing is better than just keeping your head in the sand like an ostrich and ignoring retirement because it comes at you fast.
Yeah, it's such an important point because I often get asked, well, what's that magic number? And you can't pinpoint it because, again,
Depends.
Everyone's lifestyle is different. And the decumulation strategy is very important, isn't it?
Absolutely, yeah. I mean, it can greatly increase somebody's standard of living in retirement, the amount of tax they pay. So there's some important decisions to make as you approach retirement that can improve your quality of life.
All right. Well, thanks so much for your time.
Thanks for having me, Saijal.
Well, that wraps up this edition of Strictly Money. What financial topics warrant a discussion? Email us and let us know. Stay well, stay wise, and stay wealthy. We'll see you next time.